Joint Venture Checklist. Item number 14. How will you keep track of the expenses and income from your joint venture project? Financial transparency is the backbone of a successful joint venture. When money begins to flow, both partners must be able to see clearly where revenue is coming from and where expenses are going. Tracking income and expenses properly prevents misunderstandings, protects trust, and ensures profit distributions are accurate. It also allows both partners to make smarter decisions during the campaign rather than waiting until everything is over. When partners can see the numbers in real time, they can adjust advertising, spend, modify, pricing, increase promotional activity, or correct operational problems before they become expensive mistakes. Professional operators treat financial tracking as part of the operational system of the joint venture, not as an afterthought. The financial dashboard should be as important as the marketing plan or the product itself. When both partners can see the numbers, clearly decisions become easier, conversations become objective, and conflicts become rare. In contrast, partnerships that ignore financial tracking often find themselves arguing over assumptions instead of analyzing real data. Another benefit of structured financial tracking is that it creates a historical record for future ventures. When the project ends, the partners will have a clear picture of which activities produced the most revenue, which expenses generated the strongest return, and which operational areas consumed the most resources. This information becomes incredibly valuable when planning the next collaboration. Number 1. Establish a shared financial tracking system. Before launch, agree on the system that will track all income and expenses. This system should be accessible to both partners and simple enough that updates happen consistently. If the system is too complicated, people stop updating it, which defeats the entire purpose. Many successful joint ventures rely on a shared financial document that both partners can view at any time. This transparency removes uncertainty and allows both parties to monitor performance without constantly requesting updates from the other person. Common tools include shared spreadsheets, such as Google Sheets, accounting software such as QuickBooks or Xero, Notion or project dashboards with financial sections, payment processor reporting exports. Number 2, track gross revenue first. Every financial system should begin by tracking gross revenue. Gross revenue represents the total amount of money generated before expenses are deducted. Starting with gross revenue ensures that both partners are working from the same top-line number. Once gross revenue is clearly documented, it becomes easier to analyze the performance of different promotions partners or marketing channels. Gross revenue tracking should include total sales volume, revenue per product or offer, revenue per promotional source, revenue per partner list or campaign. Number 3, document all expenses. Clearly, expenses should be documented as they occur, not reconstructed later. Waiting until the end of the campaign to remember what was spent almost guarantees errors. Instead, every cost associated with the joint venture should be recorded in the shared system as soon as the expense happens. Documenting expenses immediately also helps partners control spending. When both people can see the expense column growing in real time, it becomes easier to evaluate whether additional spending is justified. Common joint venture expenses include advertising spend, software or platform fees, affiliate commissions, payment processing fees, creative production costs, copywriting or design work, technical development, customer support staffing. Number 4, separate fixed costs and variable costs. Separating fixed costs from variable costs helps partners understand the true economics of the venture. Fixed costs are expenses that remain constant regardless of how many sales are generated. Variable costs increase as revenue increases. For example, a software subscription used to host a course might cost the same amount each month, regardless of sales volume. Advertising costs, however, might increase as the campaign scales. Understanding these differences allows partners to calculate break-even points and forecast profitability more accurately. Fixed costs might include platform subscriptions, hosting fees, or development work. Variable costs might include affiliate payouts, advertising budgets, and payment processing fees. Number 5. Calculate net profit transparently. After gross revenue and expenses are documented, the next step is calculating net profit. Net profit represents the amount remaining after all agreed expenses have been deducted. This number ultimately determines how much each partner receives. Partners should agree in advance which expenses are deducted before profit distribution. When this agreement exists ahead of time, there is no confusion later when the numbers are finalized. Number 6. Use expense categories. Organizing expenses into categories makes financial analysis far easier. Instead of looking at a long list of unrelated numbers, partners can quickly identify which areas consumed the largest share of the budget. Typical categories include marketing, technology, operations, customer service, payment processing, contractor or team support. Number 7. Schedule financial reporting. Transparency improves dramatically when partners schedule regular financial updates. These updates do not need to be complicated. A simple weekly summary can often provide enough information to keep everyone aligned. Typical reporting cadence might include daily tracking during launch, weekly reporting during longer campaigns, final financial reconciliation after the campaign ends. Number 8. Maintain documentation. Every transaction should have a record. Receipts, invoices, and confirmations should be stored in a shared folder where both partners can review them if necessary. Organized documentation protects both partners and makes accounting far easier when the project concludes. Real-world principle. When both partners see the same numbers, trust increases and decisions become objective. When numbers are hidden or unclear, suspicion grows even when no wrongdoing exists. Transparency is not just good accounting practice. It is a partnership protection mechanism. Common financial tracking mistakes. Tracking revenue but ignoring expenses. Mixing personal and joint venture financial records. Waiting until the end of the project to calculate totals. Failing to agree which expenses count toward the split. Allowing only one partner to see the financial data. Quick expense and income tracking checklist. Shared financial tracking system created. All revenue sources documented. All expenses categorized and recorded. Net profit calculation agreed upon. Reporting schedule established. Financial records stored and accessible. When income and expense tracking is structured properly, joint ventures remain transparent, professional, and profitable. The partners spend their time improving the venture rather than debating the numbers.